Hello, everyone. Welcome and thank you for joining us for today's webinar, How to Boost Your Credit Score. My name is Sarah Short and I'm the Financial Education Specialist here at Mid-Hudson Valley Federal Credit Union. And I am your host today and will introduce today's presenter in just a moment. But as always, I just want to go over a few quick housekeeping items before we get started with all of the great content that we have prepared for you today. If you take a look at your control panel that's located on the right-hand side of your screen or perhaps towards the top if you are on an iPad or a tablet of some kind, it popped up when you joined the webinar. Take a look at the questions tab there. If you have any questions at all, feel free to jot those down through the questions tab. You can write in any questions that you've come prepared with right now, so we're able to go over those later. If questions come up during the presentation as we're going through the content, feel free to write those in during the presentation, and we will leave plenty of time at the end to go over any and all questions. And please don't be shy. We have a resident credit expert here with us, so make sure that you're sending in those questions. Also take a look on that control panel. There is a chat feature, a chat box. I've dropped a few links in there as well. There's one link specifically for additional financial education resources that are available on our website if you want to click that now and bookmark that for future reference. There's also a link to our YouTube channel. Today's session will be recorded and emailed to you as well as added to our YouTube channel. There's also a number of other webinars that have been recorded as well and added to that channel. So again, go ahead and click that and bookmark that for future reference. And I've also included the link to annualcreditreport.com, which we'll go over later in the presentation. Once again, go ahead and click that and bookmark it for future reference. So without further ado, I would like to introduce our presenter for this evening, Aaron Lindo. Aaron is a consumer loan underwriter here at MHV, and he is responsible for reviewing loan applications and making lending decisions, as well as funding applications from MHV's car dealer partners. Aaron has over a decade of experience in financial services with 8 years in lending and underwriting. So welcome, Aaron. Thank you so much for being here with us today. I'm really excited to hear what you have to share with us about credit.
Hi, Sarah. Thanks for having me. Just going to turn my camera on real quick, make sure everything's all right. So let's get started. Before we get into questions at the end, we're going to go through some basics on the effective ways you can boost your credit score. So the first slide, how to boost your credit score. So we're going to go through a few basics first. I'm going to talk a little bit about what credit is, what your credit score is, steps you can take to rebuild your score, what your credit report is and what that usually encompasses, how to deal with things like collections, bankruptcy, and next steps. And then at the end, we're going to have a session where I can answer some specific questions that you might have about credit. So to start off, what is credit? Well, credit's the ability to borrow or access goods or services with the understanding that you'll pay later. A credit score is your mathematical analysis of how likely you are to pay a loan on time. It includes a history of how well you've paid, how you paid borrowers, and it's used by financial institutions like us to determine whether you can qualify for a loan or a credit card. It is one of several considerations, though. When we underwrite loans, we do look at other factors aside from just what your credit score is, but the score certainly plays an important role as well. So understanding your credit score, generally a credit score can range anywhere from 300 to 850. It does depend on the bureau. Some score ranges are a little bit different, but they're around that range. The higher your score, the more likely you are to get approved for loans and receive lower interest rates. So what is a good score? Well, I mean, a good score, it's a relative term. The average score in 2019 was 682. Good can mean anything. It depends on what you're trying to accomplish, but obviously, like, the higher your score, the lower your interest rate will be. Also, the higher probability you may have to get an approval for a loan, I would aim to keep your score at or above the average. What makes up your score? So this is really important information. So when they calculate your credit score, when the credit bureaus do that, these factors are what they take into consideration. You've got your amounts owed, which is considered revolving credit, your payment history, which is like, do you pay your bills, do you pay your loans on time, how well you've done that over X number of months, the length of credit, which is how many years you've had open credit, like credit cards and things like that, new credit, which is how many new accounts you've opened recently, and a credit mix, which is a mix of different kinds of credit. So like a mortgage would be different than an auto loan, which would also be different than a credit card. Having a mix of those things on your credit report generally will make your score higher. They like to see that you can borrow different types of credit and pay them back on time. But if you look at the weights here, it's really important to recognize that payment history is absolutely the biggest factor when it comes to making up your credit score. Something like being late on a credit card or a car loan can drastically impact your score. It can bring your score way down, especially if it's reporting as currently late. Obviously, your score can recover if you take care of the late payment, but it does take a while for it to fully recover if it does show up that you made a late payment. So it's really important that you make sure that you keep your payments on time, as far as the credit report is concerned. It can be quite unforgiving sometimes when you have too many late payments on there. And then the second biggest factor, amounts owed, that is a little more complicated. That's what we call capacity. And basically that's just kind of the ratio of what you owe on your credit cards versus what your limits on them are. So what you're doing to hurt your score. Well, there are several things you can do that can definitely impact you negatively. Obviously, as I just pointed out, making your payments late is probably the biggest one. Carrying balances on your cards is probably the second biggest. That's your capacity that I was talking about earlier. Ideally, you want to have all of your credit cards paid to zero at the end of every billing cycle. That way, the credit report sees that you have all of your credit available. So that's really good for your score. Regularly applying for new credit, that can also hurt your score. Generally speaking, the more accounts you open and the more inquiries you have in a short period of time, it'll bring your score down. Opening new lines of credit also decreases your average age of credit because it takes the average of how many years you've had your credit open. So if you have several cards that, let's say you've had open for like 10 years, and then you apply for 5 new cards, it's going to factor in that now you have these new cards that have no years against the older ones, and your average age of credit is going to go down, which will ultimately drop your score in some way. Never using your credit card, this isn't really going to negatively, it's not going to drive your score down, but it's not going to help it either. So if you never use a credit line, you're not going to get any credit for making your payments on time. It'll just have an open line there. So ideally, you do want to use your credit if you can, but never using your card, it's not really going to bring your score down. The only risk you have with never using your card is sometimes your creditor can close your credit card for inactivity, in which case the credit report will no longer have that listed as an open asset for you. So what that'll do is not only will it lower your age of credit, but it will also lower what you may have for your revolving availability, because now that line that you had open that was available to you is no longer there. So it is definitely something to keep in mind that you should try to use your older credit cards at least once in a while in order to make sure that they don't get closed or fall off your credit report as an open line of credit. And just touching on that again, closing old credit cards, that's the same concept. If you have a credit card that you've had for many, many years, and you decide, you know what, I never used this card, I'm going to just close it out, there's no reason to have that, it's actually better not to do that. It's better to actually just leave that card open, even if you never use it, even if it's not in your wallet. It does have an impact on your credit score and will help your score stay higher because of having it for a long time and having revolving availability to you. Those things are actually important to keep your score good. Only making the minimum payment on credit cards, this really has to do, again, with keeping those balances. If you have a large balance on your credit card and you let it carry over until the next month, your available credit on your credit report is going to be limited. And if that happens, your score will go lower. It does keep track of how much available credit you have. So you really want to try to keep your credit card balances as close to zero as possible at the end of the month. Doesn't matter how much you put on them during the billing cycle. You could even max them out all the way to the limits if you wanted to, as long as you can pay them off in full at the end of the billing cycle. Improving your score, there are definitely a bunch of things you can do if your score is low to improve it. Pay off your credit cards like I was just talking about. Consolidate your debt. This is actually a really cool trick you can do if you have a lot of credit on your credit cards and you're not able to pay them off, like maybe you're making minimum payments every month on them. You can do something like take out an unsecured loan, like a personal loan, and transfer or pay off those credit cards using that loan. And what that does is often it'll give you a lower interest rate, which is nice. But in addition to that, it also frees up all of that revolving credit that you would have normally had if you paid off your cards. Because installment loans, like personal loans, are not factored into your revolving availability. It's only looking at stuff like lines of credit and credit cards, things that revolve, like that you can pay on and then pay back, etc. Something like a car loan or a personal loan, those aren't revolving lines of credit, so they don't impact that ratio of availability that impacts your score. So a good way of getting around that, consolidating your debt by using an installment loan, like a signature loan or personal loan, to pay off your credit cards can have a big impact on improving your score in the long term. Pay on time, of course. Obviously, if you are late on anything, if you are able to bring it current, your score will improve quite a bit if you're actually running behind. And ensure you have a credit mix. So, I mean, it's not always available for maybe newer borrowers, but ideally, you want to be able to at least have a couple of credit cards and some kind of an installment loan, be it a car or a signature loan of some kind, a personal loan, anything that you borrow at a fixed amount and then pay back over time. That mix, the credit score likes to see that a lot. A mortgage would also add to that mix. I mean, it's not always available for everybody, but that's the ideal scenario, is that you're able to have a mortgage, you're able to have a car or a signature loan, a personal loan, and credit cards as well. So to rebuild your score, I get asked this question a lot. A lot of people who maybe had some hiccups with their credit or went through a bankruptcy or went through something in their life and their credit score kind of suffered for that. Some of the best ways to kind of rebuild your score from the ground up, if it is on the low side, is you can get a secured credit card. This is a fantastic way to start building your credit. Generally, if your score is low or you just don't have any credit yet, maybe you're a new borrower, it's very hard to get approved for a credit card, but a secured credit card is an option that's usually available to everybody. It's not something that we require strict guidelines on. It's usually a guaranteed approval. And basically what it is you just secure a credit card with some money that you have in your account. So if you wanted a $500 secured credit card, you would need to have that money available in your savings account in order to back up the card. And having a secured credit card to the credit score, to the credit report, it's exactly the same as if you had an unsecured credit card. So it doesn't know the difference, which is really good for people who want to start building their credit, because you're going to get approved for it, it's guaranteed, and you can start building your credit score up by having that credit card available to you and making your payments on time, using it every month, and doing the same thing you would do if you had an unsecured credit card. So it's a great tool to start building your credit up. Become an authorized user. That's another thing that can be done. You can add yourself to another line of credit that someone else has, if they allow it, of course. It can be useful for, again, newer buyers to add their name onto a line of credit that's been well established by maybe like a parent or someone in their family that they trust. It will show up on your credit report as a line of credit that is open, which is nice. And there is also the caveat that a lot of times you can actually add authorized users to your lines of credit that aren't even 18. So if you have a younger child who's maybe a teenager or something like that, technically speaking, you can actually add them as authorized users to your lines of credit, which can help them get a head start on building their credit score once they turn 18. Use a cosigner. This is a great tool as well if your credit is poor or is low and you have access to somebody who you can trust that is willing to cosign a loan for you, that has strong credit. It's a great way to get approved for a loan or a credit card and allow yourself to start rebuilding your credit from there. And be patient is definitely one of the biggest factors. Credit scores can take some time to go up. If your credit has had a lot of hiccups and you've got a lot of things that have negatively impacted the score, sometimes even if you do everything right, it's going to take a while before your score really can fully recover from some things that happen to it. I do have people ask me, how can you get from a 500 to an 800? And it depends on what's on your credit report, because sometimes those things can take years to actually have happen. Some of them are easier. It's situational for sure, but patience is a virtue. Everything takes time. The credit report looks at history. It's very important that consistent history is shown. So going from not paying to paying, it's going to take a lot of payments to really balance those things out. So definitely be patient. So the credit report itself, there are three major credit reports. There's Experian, Equifax, and TransUnion. And they all balance out a little differently in terms of how they calculate your credit score. So it's important to recognize that your score on Experian, it may not be the same as your score on TransUnion or Equifax. Each one has their own criteria. They all change all the time. It's very hard to predict, which one will be higher or lower. So in general, it's just good to try to do the right things to keep all your scores higher if you can. So your credit report details the specifics of your credit history. It has information like your name, your date of birth, your social security number, your past addresses, aliases, names, things like that. It keeps track of what accounts you've borrowed on, mortgages, loans, credit cards, lines of credit. It includes your history and status, like it'll tell you if those lines are open or closed. It'll generally tell you how many on-time payments you've made on them, the balances owed on them, things like that. It also includes public records, which are like if you file bankruptcy or you have a lien placed against you for a large sum of money or some kind of a federal judgment. Those things are going to show up on your credit report also. And recent inquiries, like that would be where you've recently applied for new credit. So if you put an application in for a car loan or a credit card, you'll see those inquiries appear on your credit report as well. So you can kind of see who you've been asking for credit. Sometimes it'll even be nice and give you like a little denotation that'll tell you, was it an auto inquiry? Was it a credit card inquiry? Doesn't always know, but sometimes it will tell you that. One great resource, as you can see in the bottom left corner there, annualcreditreport.com is a website that allows everyone to get a free copy of their credit report every year. You can only ask for it once a year for free, but it is nice because it will give you a breakdown of all that information that we just went over. It will not tell you your credit score though. Your score you do have to actually pay a small fee, I believe, for, but it's a great way to actually see what's on your credit report and know what they're looking at, what's there, especially if there's some miscellaneous items you may not think of, like maybe there's a random bill that you forgot to pay at one point that's hurting your score and you weren't sure why. your credit report should tell you what that is. So it's a great resource to definitely take advantage of to make sure that you're monitoring what's on your credit report. So how long do items last on your report? So open accounts in good standing, like a credit card you opened 20 years ago, that's still open. That's always going to be on your credit report as long as it remains open. Open lines will just not fall off your credit. Closed accounts in good standing, generally about 10 years, they'll stay on there, even if you close them out. So that's like, car loans you've had in the past, things like that. Late or missed payments, 7 years it will remember. I will point out that when it shows your chronological payment history for an open line, it generally will only show the first 2 years, but it will definitely have an impact for a lot longer than that. It just doesn't necessarily show you. So if you had a late payment like 6 years ago, you may not see it on your credit report. It won't tell you what month you paid late, but it will reflect that there was a late payment on it. Collection accounts can stay for 7 years as well. Things like medical bills, utility bills, things that never got paid that went to collections. Those things generally stay 7 years on your credit report before they age off. Chapter 7 bankruptcy is 10 years, and Chapter 13 is 7 years. And credit inquiries, like when you apply for new credit, those will impact your score and generally show up on your credit report for 2 years. They do only have a big impact for the first 12 months, but they definitely do show for 2 years on your report. Removing collections. This is another thing I get asked a lot. People asking, how do I get collection accounts or negative accounts off my credit report? There's a couple options that work. Paying or settling the collection is obviously probably the best option. Some collectors will remove collections from your credit report if you pay them in full. Some of them will not. So when I tell people who are trying to remove collections, I generally tell them, do your best to try to get the collector to agree to remove it from your report, because when something is removed from your credit report, it is a lot better than it showing as a collection that was paid, because it's still going to show up as a collection account on your credit report. Even though it changes its status to paid, it's much better to just have it not show up at all. You can also dispute items on your credit report as well. Obviously, if something is on your credit report, like a collection account that you do not recognize or you do not believe that you owe, disputing it is certainly the best option to go about doing that. And basically to do that, you have to make accounts with the credit bureaus and dispute them individually. And waiting. Sometimes, as you saw before, some collections, if they're older, after 7 years, they can fall off your credit report and may no longer impact your score. So if you do have older items that are on there, sometimes just waiting and they will age off on their own. Inquiries will age off as well. Your score will gradually go up as those items become further and further away from the current time. So we're going to get a little more in detail in terms of how to kind of go over each of those things. So paying and settling collections, the first step for that is you want to contact the collection agency that has the debt, not the original creditor. So for example, like if you have a medical bill and you went to a hospital, the collection company that has the debt is not the hospital itself. It'll be a company the hospital hired to collect the money. And generally you have to deal with that company specifically in order to resolve the collection. So if you call the hospital, they'll probably just redirect you to the collection agency. But generally, when you look at your credit report, you're going to see the name of the collector, the collection agency on there, and that's really who you want to reach out. I generally tell people, try to Google the name. Usually you can get a phone number that way. You can give them a call, tell them your name. They can look up your account, and from there, you can work out a resolution for paying the debt or settling. When settling a collection, as I said before, you want to try to make sure that you get payment confirmation or a receipt of payment. This is going to protect you in the event that it doesn't get changed on your credit report for some reason. And you also always want to ask the creditor to remove the item from the report. It's so beneficial if a creditor is willing to do that, because whether you pay it in full or settle it, the creditor will be able to remove the item if they choose to, which is very helpful for keeping your score higher or rebuilding it from the collection account. If you settle instead of pay in full, then the item will display on your credit report as settled for less than amount owed, which again is better than it being fully owed and whatnot, but not as good as having it removed entirely from your report. So just keep that in mind. When it comes to disputing collections, as I said before, if you don't remember owing a debt that's on your credit report, or you're pretty sure it's a mistake or something, definitely a great idea to dispute that item. You can go to each credit bureau's website and make an account. It's pretty simple. It doesn't take too long to set up accounts with Experian, TransUnion, and Equifax. From there, it's pretty easy to follow the prompts to set up a dispute. It'll ask you what item you're looking to dispute. It'll usually give you a list of what's on your credit report. You can choose the collection item you wish to dispute, and then they'll do an investigation into that. The creditor does have to respond within 30 days, and if they can't verify that you owe the debt, they remove it. So it is a very useful tool, especially with medical. I'll get more into that later, but basically, if the creditor, the collector, does not respond to your dispute saying, yes, in fact, you do owe the debt and can prove that you actually owe it, they will take it off your credit report. So it's a great way to kind of remove some of those negative things impacting your score. And it can be very effective for both things that you maybe do owe and things that you haven't owed. And then, of course, waiting for collections to fall off. They can remain on your account forever. That is one thing that I do remind people, because I think a lot of people are aware that collection accounts have a timer on them and that like older items can fall off after 7 years. But there have been cases where the collector will actually renew the item on the credit report again. So you could owe this debt from a long time ago, and if they're actively collecting on it, they could simply resubmit that item to the credit report again, saying that you still owe it, and then it would come as a new collection account and continue on another 7-year term. So it can be dangerous to just hope that all your collections are going to fall off after 7 years, because it's not guaranteed. They can certainly renew them, especially if they're larger balances or collectors that are very aggressive in terms of trying to get paid. Obviously, calling them and trying to work out a resolution is a safer and probably more reliable way to kind of deal with those issues. And each year, a collection account that's on your credit affects your score less. So if it's a new item, it's going to impact your score a lot. If it's an item that is 6 or 7 years old, it's going to impact your score a lot less. So it'll still count, but your score will actually gradually go up on its own. Even if you have older collections every year, even if you don't pay them, your score will slowly rise as long as you aren't continuing to do things that are driving it down, like adding new collections or paying late on your current bills. So it's good to know that, just because when you're trying to figure out how to handle paying off a lot of collections, I always tell people the best thing to do is try to resolve the ones that are the most recent first, right? Because they're going to have a bigger impact on improving your score than paying off something that's, say, 5 years old, which has a very smaller impact than something recent. So waiting is not ideal. It's better to pay, settle, or dispute items if possible. Waiting is a slow process that will eventually help your score, but it's certainly not going to give you the same impact as if you actually handle these items on your own individually. So it does require some legwork that I tell people, put the work in, call the creditors, make a plan, settle your debts, work something out. It's extra work, but it's worth it. You can gradually increase your score by waiting, or you can drastically increase it if you can actually handle some of the items that are driving it down. So it's good to be proactive in this case. Bankruptcy. So if you have to file bankruptcy for some reason, be it Chapter 13 or 7, recovering from bankruptcy is very similar to just having no credit or starting from scratch. After a bankruptcy, the slate is pretty much wiped clean. Usually all of your credit lines are closed. your score will drop significantly if it was good, because a bankruptcy is a negative factor that is also a public record on your credit report. So when you get discharged from a bankruptcy, the best thing to do is treat it as though you just started your credit life again. So you want to establish new lines of credit, open a new credit card, like a secured card like I was talking about, maybe get an auto loan or a small personal loan if you can still qualify. I say getting an auto loan is a good option because a lot of car loan options allow you to qualify even if your score is low, as long as you have good money down or you have income to support the payment. So it's a great way to kind of boost it up. You can also do something called reaffirm your existing vehicle. So if you have an open auto loan during a bankruptcy, you can reaffirm that auto loan you have, and it will carry on after the bankruptcy is discharged. Like, for example, if you need the car to get to work, generally speaking, the court will let you reaffirm that vehicle loan, and you can continue to make on-time payments on that, even throughout your bankruptcy. And that's going to help your score recover a lot faster because you're going to have an open paying account that is showing up positive that didn't get close to the bankruptcy. So good option. Hopefully, if you ever have to go through a bankruptcy, your lawyer will direct you toward that option if you can. But I always tell people it's an option just in case they don't know. And you know, if you have any additional questions, like maybe you did file bankruptcy, you can certainly ask them and we can hopefully answer them later. Student loans, that's another thing I get asked a lot about. Loans in deferment don't affect your FICO score. I think that's probably one of the most often questions I get, especially considering the pandemic right now. A lot of student loans are actually in deferment. So the good thing to know is they're not driving your score down to have them deferred. They don't really impact your score at all because they're not showing as paid or unpaid. Loans in forbearance don't give you credit history, but also lower your score. So if you're going through like a financial hardship of some kind, hold on, I'm just gonna move this. It's good to know that forbearance is an option for student loans, and it won't help you build your credit, but at the same time, it will protect you from going delinquent or ending up in default on those loans. So being in default on student loans is really the worst possible scenario for your credit score. You don't want to be late on anything, and student loans are no different in that respect. A good thing to know, though, is student loans actually affect your score less than other loans do. So both for good and bad history. So if you do have a lot of student loans and you are actually in default on them, it's not going to hurt your credit score as much as if you're in default on something like your credit card or your car loan. It definitely will still drive your score down, but it's not quite as significant. And the main reason behind that is they're federally backed loans most of the time. And given the nature of high balances on student loans, I think it would be very difficult for people to recover if they had the same impact. So that's good to know. At 270 days late on a student loan, your federal loans enter default status and your score will drop significantly more than if they were just late. It is very important that you don't let this happen. A lot of people who are struggling with their student loans generally don't know what to do about them, and they'll kind of just leave it alone, or they won't answer the calls. If you get to the point where you're at 270 days, your score goes down quite a bit. And from there, it can take quite a while for your score to recover. Even if you do actually work out a payment plan and get them back into good standing, you definitely want to deal with it before it gets to the point where they're that far behind. If you are behind and haven't begun to pay your student loans, the best thing to do is to just contact your lender and get into a payment plan you can afford. Student loans have tons of really easy to afford payment options that you can utilize if you are worried about paying your loan, especially if you happen to not have work or an income at the time. There are income-based options for repaying student loans that sometimes can make your payment even $0 if you don't have an income currently. So it's very good to be, again, proactive. If you know that student loans are going to be due, definitely reach out and try to get into a plan you can afford. If you have large balances on your loans, odds are good it's going to be very difficult to manage a monthly payment from your standard payment. Sometimes they'll just give you like a 10-year repayment plan. That can be very difficult, but rather than not pay, it's definitely good to kind of look at your options in terms of how can you consolidate them, how can you get into a payment plan you can afford on them, in order to protect your credit score and just keep everything in good standing. Some next steps, like I said, if you can, check your credit score. There are several ways you can keep an eye on it. Obviously, paying for your score through annualcreditreport.com will give you your credit scores. And I want to point out this is the most accurate way to get your credit scores, because those are the actual scores from the bureaus, which means they're going to be the exact scores that your people like lenders will see if they run your credit. Companies like Credit Sesame or Credit Karma are great tools to monitor your credit report and your credit score. However, I do want to point out those aren't exactly your credit score. The third-party companies like Credit Karma, they kind of use an algorithm to guess around what your score will be based on what they have information for. It's usually pretty good. I will say that like I've seen them be fairly accurate, but they can also be wrong. So it's good to know that if your Credit Karma credit score says your score is 700, it's possible that your Experian score, your Equifax score may be 690 or 680. It could definitely be lower. It could be higher. It's not a guaranteed factor. I definitely want to remind people of that because it can mislead you in certain instances when you're applying for a mortgage or a car loan and you expect your credit score to be this and it's a little lower. That's just because those aren't the actual scores from the bureaus. So it's good to remember that. You can certainly get them if you're willing to pay on annual credit report for them. But still, Credit Sesame, Credit Karma, and those other features, even like Capital One and other card companies are starting to offer score and credit details. Those are great things to pay attention to because they do give you a general idea of where your score is and what is on your credit. So good tools to utilize. Check your credit report from all three bureaus using annualcreditreport.com. This is the most accurate way to make sure you know exactly what's on your reports from the actual bureaus themselves. Great tool to use. And just continue to be proactive and monitor your credit as best you can. And if you see something that looks off or see something that is probably that you don't recognize, or even just something that you do recognize, try to be proactive in resolving that issue, like a collection account or something like that. You can also visit mhvfcu.com/ebooks and download Using Credit Wisely. We have a great ebook available to download. And lastly, we also have a partner company called Balance. They offer financial counseling and set up consultations with representatives and an MHFCU partner. They're very, very helpful. I've spoken to them a few times myself. They're great at setting up things like preparing a budget plan for you. They can help you organize your finances so that you can catch up on bills you're behind on. And they also actually offer like credit report review. So they can actually go over your credit report with you and kind of walk you through some of the stuff that I just talked about and maybe give you a better idea on how you can handle working on rebuilding your credit or dealing with some of the issues you may see on your credit report. You can see there's a number there you can call to speak with a counselor, but they're definitely a great resource to use if you have financial concerns or struggling in some way financially to help you out with those things. All right, and then at this point, I can definitely take some questions. If Sarah wants to jump in and if there were any questions asked by any of the listeners, we can try to go over those.
Yeah, of course. So let's see. If you have any questions, feel free to type those in right now, and I will read them aloud as they come in. Your name won't be included, so it's completely anonymous. I also want to add that as you're leaving today, there'll be a survey that's going to pop up on your screen. If you could please just take a moment to submit some feedback based on today's webinar. We use that to continue to improve and to provide relevant content for you on your financial journey. So thank you in advance to those of you that are able to take the few moments to submit feedback that way. While we wait for some questions to come in, Erin, do you want to go over medical bills or medical collections? Do you have any pointers on that area specifically?
Oh, yeah, absolutely. I may have skipped over that, but sure. So some things about medical bills. One of the biggest factors is disputing medical bills is a very effective tool to remove them. One thing to remember is because of HIPAA laws, sometimes it can be difficult for a collector to get credit information back to the credit bureau in case of a dispute, which can ultimately sometimes result in them removing your item. So if you have a miscellaneous collection from a medical company that's 3 or 4 years old and you decide to dispute that, Experian or whoever the bureau is will reach out to that collector and say, prove that this person owed this bill from this medical procedure. And a lot of times they may not be able to do that, which is really good because it allows them to remove it from the report. So when if you see medical bills on your credit report, disputing them is a very, very effective tool to take care of them in some cases, especially if you don't remember what it was for. I always say that because, miscellaneous bills from credit, from medical seem to come up a lot in people's lives, and they aren't always correct. Sometimes, the insurance company paid it. Sometimes it was a duplicate or a second bill that was incorrect. So it's definitely important to check those things. Medical bills also do tend to age off as they should. If you have a bill that's 7 years old for medical, odds are good it will probably age off. I've rarely to never seen medical bills get renewed by collectors. I don't think they're that aggressive in terms of renewing them. So it's good to remember that they will age off. As I pointed out earlier with medical bills, if you're trying to deal with them and actually pay them off and settle them, things like how recent they are matter, and also the size as well. So the larger the bill, the more impactful it will be on your credit report. If you have a medical bill that is like $4,000, it's going to impact your score a lot worse than if you have a medical bill that's like $60, like a copay you missed or something like that. So in general, you want to address the larger items first and the more recent items first, because those things have a bigger impact on driving your score down than older items and smaller amounts. But yeah, they function very similarly to the way a utility bill or another bill collector would on your credit report, with a few of those exceptions being they're easier to dispute because of certain issues with medical laws. But I do find that medical bills seem to be the most common collection item that you find on people's credit reports. And I think a lot of that is because certain bills may not get recognized as owed, stuff like copays or insurance that ends up falling through the cracks. It's very common that things appear on people's credit that they don't recognize or weren't even aware they owed. So again, monitoring your credit report is a great way to catch those things and make sure that you settle them as fast as you can to keep your score healthy.
Okay, great. Thanks, Erin. So we do have a few questions. Please keep them coming in. We'll go over them as they're received. So the first question we have is, I have a Reflex card which charges me $10 per month and $99 annually, which I wish to close because of the annual cost being too high combined with the interest. How can I close the card without it looking negative? It's called the Reflex card. Can I call and negotiate the annual fee off?
Okay, well, I don't really know whether or not the card company will allow you to negotiate the fee off. I would say, obviously, it doesn't sound like a great card product if they're charging you annual and regular fees on the card. So I can understand the desire to close it. I would say you kind of have to weigh your options between how much it's going to impact your credit versus how annoying it is to pay the fees. I would say that if it's not something that is your only credit card, like if you have other credit cards and it's not your oldest credit card that you've used forever, that's your only line of revolving credit, it's probably safe to close that card. It may impact your score a little bit, like it's going to affect your age of credit, of course, and hopefully not your capacity, but it could. But it's really kind of an option for you. Like, I would tell somebody, probably, if you can't get rid of those fees, I would recommend closing it, unless it is your only credit card. If it's your only credit card, I would suggest trying to sort of build up a second card before you do close it, because you do always want to have a revolving line open, and you do always want to have revolving credit available to you for your score to remain strong. Like, the difference between closing a card and keeping one open, if you have a lot of them, is not a huge impact. So you definitely want to prioritize it like that.
Okay, so they said thank you. It's not their only card. They have other ones as well. If you have any follow-up questions for that, feel free to type those in. Our next question is, why are credit scores so different between the credit bureaus?
Well, I mean, every credit bureau has their own algorithm that tries to evaluate the risk. I mean, that's ultimately what the credit scores are, is they're supposed to be an evaluation of how risky a borrower is. Like, how likely are they to repay the loan that they apply for? Every credit bureau has their own like algorithm that it runs to calculate your score based on what they consider risky. So they may say that X bill is 10% more risky than the other bureau says it is, which can result in your score being different by 5 points, 7 points, etc. I haven't seen dramatic differences in credit reports unless an item isn't listed. That is one thing that can impact it. So you could have a scenario where a medical collector or another bill or something that's in collections, they may not report to all three bureaus. They may only report to 2 or 1. If that's the case, the bureau that does not have the collection is likely to have a much higher credit score than the others. So that is something to consider. If you do have a case where you have a medical or another bill that's in collections that's showing up on your Experian or one of your other bureaus, but one of the other bureaus does not show it on there, then that's going to be the primary reason why one of your scores is much higher. The companies aren't required to report to all 3 credit bureaus for everything they report. So that can cause some pretty big discrepancies in the scoring. Otherwise, if everything's reported the same, it's really very close. I haven't seen a dramatic difference in scores. You're talking about maybe a 20-point difference usually, or less. It's usually between 0 and 20 that I see, but I never really see a huge swing in it if everything is being reported the same.
Okay, great. So these are great questions that we've had so far. Please keep typing those in. Again, it's anonymous. Your name won't be read aloud, so feel free to type in any and all questions that you have. We'll need just a few more minutes to do that. Aaron, do you have any specific advice, or I don't know, anything specifically that you would want to mention in regards to credit or credit reporting? Any fun stories to share while we wait for more questions?
Fun stories to share. Well, I mean, I've seen some interesting things on credit reports, certainly. I mean, I've seen like a public library report a collection for a book that never got returned.
Wow.
Yep, some interesting stuff, and this is something like, they'll submit it to Experian and say you owe $34 for the public library, which, you'd think, why would that ever show up on your credit? But it's just a friendly reminder, these things, they can show up. Anything that you don't pay, that you get a bill for, theoretically, I mean, could make it to your credit report as a delinquent item. So it's really good to keep an eye on that stuff. If you get a bill you don't recognize in the mail, definitely don't ignore it. I mean, you don't want it to end up randomly on your credit report, especially if it's not something you even owe. So it's good to keep that in mind. Also, one thing that's interesting is the credit algorithm has changed a lot over, the last few years that I've seen, and it actually has increased for the better for new borrowers. I've noticed that your credit score now will be much higher as a newer borrower than it used to be in the past. So like if you're like a younger borrower and maybe you only have 1 or 2 credit cards and you've never had a car loan and you've never had a mortgage, but you pay those credit cards on time every month, you use them, you keep your balances low or at zero at the end of the billing cycle like you should, I've seen very, very, very high credit scores just from these basic actions, like even as far as almost 800. And before that was never possible. You'd see higher 600s for newer borrowers, but you'd never see high 7s or mid 700 scores for someone who only has 1 credit card. But today, the algorithm is much more favorable for those younger and newer borrowers. So it's good to keep that in mind if you don't have credit, or you know somebody like you have a child or a grandchild or something that's about to start their financial journey, about to become an adult. It's really good to let them know they can end up with a very strong credit score if they just follow the simple steps to start building their credit up early, which can help them a lot in life. It can save them a lot of money in interest on loans, help them get started with a first-time car. So very useful to make sure that you keep that in mind and spread that knowledge. Make sure everyone knows credit is important. It does impact a lot of factors and can ultimately determine how much money you pay over the course of your life. Almost everybody borrows money at some point. So having good interest rates is very, very good to have. So very useful to have high credit score.
Yeah, absolutely. So we do have a few more questions that came in. What if you have illegal collections against you, but they do not show up on your credit report since they were 12 years ago? If they do a deep search, do they show up?
Well, there's no such thing really as like a deep search. I mean, when you're talking about reviewing credit, it's banks and financial institutions and other places that run your credit. They're only going to see what the credit bureau is willing to show. And the credit bureau is going to show exactly what it shows to everyone. So there's no difference between me running your credit or let's say a rental company running your credit or an insurance company running your credit. They're all going to see the same information. So if you're saying that those older collection items are not reporting on your credit report, they're not going to report on your credit report for anybody. No one is going to know they're there as long as the credit bureaus are not showing them, which if they are in fact that old, they should not, right? Unless for some reason one of the collectors decides to renew that debt as a new collection and have it reappear on your credit as a new collection, you're probably in the clear. I wouldn't say that your credit will reflect any of those things or have it impact your score at any point from here on out.
Okay. Our next question, does your debt to income affect your score?
No, the debt to income ratio is something that we use to approve people for loans, yes, but it has no impact whatsoever on your actual credit score. Your credit score only cares about how you pay back borrowed money or if you don't pay something that you owe, like a bill. How much money you make versus how much bills you have, that is just something that creditors use to qualify people for loans, but it has no bearing whatsoever on what your credit score is.
Okay, great. And then our next question, how many credit cards are normal to have at one time?
I mean, I don't know what the average is for people, for adults in America. It's good to have what I suggest. It's good to have at least 2 at the bare minimum. Generally, when creditors are looking at your credit profile, they will consider anything like 1 credit card or 0 a thin file or like limited credit. So if you have 2 or more credit cards, that's usually a healthy number, but having something like 8 or 10 even really isn't that bad for your credit, especially if you've had them for a long period of time. Like I probably have at least 10. I don't really use them all, but I do make sure they stay open. But because they are so old, because I've had them for so many years, they're helping my average age of credit. So I leave them alone. But there really isn't any negative to having a lot of credit cards open. It's only negative if you continually open new ones, because that can lower your score because of the age factor, as well as adding the new line of credit. But I would say having 2 is good. Maybe even having 3 or 4 might be slightly better. But it really just comes down to, do you use them every month? Do you pay them back on time? Because each on-time payment you make on a card, you get payment history for that, and it counts that history. So if you have 2 credit cards and you make an on-time payment every year, then you're going to get 24 payments on time. So that's good. And if you have like 5 credit cards, then you get 60 payments on time. It might be a little better for your score, but it's not a big difference. Like, you're talking a few points at most, right? You may see 2 or 3 points more if you pay more on time, but those things matter very little in terms of your score.
Okay, great. So we'll leave it open just a minute longer for any additional questions to come in. Aaron, do you have any final words of wisdom to leave with our audience today on credit?
Well, just pretty much reiterating, spread the knowledge, right? And the best thing you can do is be mindful of what your credit is. Pay attention to your score, pay attention to what's on your reports. Tell your friends, tell your kids, tell your grandkids, keep an eye on that stuff. It really does, it's something that a lot of people tend to not understand or just kind of not worry about, but it does make a big difference. And I try to stress that to everybody, that the best thing you can do is, do your own research, keep an eye on it, and just maintain it the way you'd maintain anything else, especially when it comes to, making your payments on time, and even using your lines you don't normally use. I mean, that too, right? If you have a credit card that you haven't used in 6 years, maybe make a purchase on it and then pay it off. Just, it can't hurt. It'll keep that card open. It'll keep it active. It'll give you payment history. Just always keep mind of those things.
Awesome. Okay, well, it doesn't look like we have any other questions. A few thank yous and great information. Thank you so much, Aaron, for being here and for sharing your knowledge with all of us. We really appreciate it, you taking the time. Thank you, everyone, for joining us for this session. I hope that you learned a bit more about credit and some tips that you can implement in your own financial journey. So with that, we are at the end of our time together. So thank you again, Aaron, everyone that's here, and have a fantastic rest of the day.
Yeah, thanks, Sarah.
Take care.